1 year ago, interest rates were at zero. Today, they're at the highest level since October of 2007. That's bad company. What's this mean for the markets and for you? I've got that and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. The Federal Reserve met expectations this past week. They met expectations by increasing the Fed funds rate, their interest rate that they control. They control all of them, by the way, and raising it 0.25%, 25 basis points, if you're cool. That's what you'd say. Moving it to 4.75%. Now, a year ago, guys, it was zero. A year and a half ago, the Federal Reserve was saying, we don't even think there's inflation. We're not even going to we're not even thinking about raising interest rates. 6 months before that, they were saying, we're not even going to create inflation by printing all this money. So it's pretty astounding, but we have had a surge in interest rate hikes, not the fastest interest rate hikes ever, but the fastest off of zero ever. At least that's what I'm seeing, and the fastest in 40 years that we've increased interest rates. But the Federal Reserve met expectations. Why? Because it wasn't a 75 basis point increase or 0.75. It wasn't a 0.5% increase. It was a slower pace, 0.25%. Everyone expected that. I think had they done anything different, it would have really created a lot of chaos on Wall Street. But here's where the rubber meets the road. What does this mean? What's it signal to the markets? What's it mean for the bond market? And what's it mean for you? Okay, so what does the 0.25% interest rate hike first day of February, what's it mean for the markets? It means good news, guys. It means good news. And the market responded from this as Fed Chairman Jerome Powell was actually making the announcement of what the interest rate hike was going to be. The markets didn't move immediately, and then they started moving based on the tone. And there's all sorts of geeks out there. Was it a hawkish tone? Was it, very aggressive and stern? Was it dovish, very sensitive and cautionary? And they officially said we're moving into a disinflation stage, not a deflation where prices are actually going down, but the rate of inflation, he said, it's noticeably diminished. And so that's a positive sign. And that was sort of the obvious, if that is the reality, which I just did mention, the Federal Reserve has been wrong at every step of the way. It seems like they might be right this time. But by the way, the last time we saw runaway inflation like this was in 1980, in the early 80s, and we had a double top inflation. It went up, it came all the way back down, and then it went up again, right? And so that's a possibility. That's the last time we had this sort of errant monetary policy and everything as well. So we'll see. But if you do look and say, yeah, inflation is coming down, prices are still high, but they're not increasing as rapidly, and there's signs that the economy is slowing and so on, then, the Federal Reserve should slow how much they're raising interest rates. And so this was definitely that sign. So suggests the market should be more predictable, should be more calm, should be more focused on normal metrics of profits and profit growth and economic factors. That should be more in the driver's seat with Wall Street, as opposed to, well, what's the Fed going to do? They're going to drive everything. Cautious optimism is what this means for the overall markets, but not rampant greed. And here's why. Don't fight the Fed. Well, yeah, the Fed is not raising interest rates as fast. I know. But they're still raising rates. They still raised rates. In fact, again, they've raised rates extremely aggressively over the past year. Did they break something? We don't know. We don't know yet if they raised rates too much, too quickly. We also don't know if we're going to see a double top inflation and it wasn't enough. So is speculation going to run away again and all of a sudden we've got to raise rates again? I don't know. So this is cautious optimism for the markets because the interest rate increase didn't shock anyone and came in at a low 0.25%. What's it mean for the bond market? To me, this is good news for the bond market. it is, because last year was the worst year in the bond market since the index started back in the 70s. At one point, it was the worst year for government bonds since the ratification of the Constitution. And so why was that? Well, because interest rates and bond values move in a teeter-totter. So interest rates were at 0 to start the year, and they moved them up significantly. And as they moved them up so quickly, bond values dropped. At one point, they were down almost 20%. Finished the year down, I believe 13 was the aggregate bond index. And so this is good news for bond investors, because this is sort of a clear signal that based on everything the Fed can see today, they actually don't need to continue to be aggressive with interest rate hikes. Therefore, we shouldn't, unless something changes, see a repeat in the bond market of 2022 in 2023. In fact, this also potentially suggests that the Fed is seeing the economy slow down, and therefore they're going to move from rate increases to no rate increases to rate decreases at some point, which would be beneficial for the bond market. Guys, it was awful for bond investors. Those of you that are using bonds are likely in retirement or at the edge of retirement, and that's not the time you want to see that level of volatility in your bond investment. So I understand the reason to be very cautious and anxious about bonds. This suggests that we shouldn't see a repeat of that in 2023, and that things could be more normal and much better for bonds in 2023. We'll see. Only time will tell, but that's what this interest rate move says. And then finally, just practically, these interest rates influence us as consumers in different ways. So if you're a saver, what does this mean? I think your savings account might still go up a little bit in interest rate, right? If you're just using a savings account at the bank, it's still paying point nothing. 0.2, I had someone reach out to me earlier this week and say, well, I've got this bank account earning 0.2. Should I do something with it? Yes. Savings account should be paying 3% or more right now, and we might see that increase a little bit because of this interest rate increase, right? So that could still be happening. I would expect that CD rates, longer-term CD rates, are likely going to be going down. They're going to be more muted. So you're likely going to get a 1-year CD that maybe is more stable, but if you try to look at a 2-year CD, 3-year CD, it's not going to be as attractive. So you're going to see short-term interest rates, that high yield savings account, that interest rate's going to stay stable, maybe go up a little bit after this news, but I don't think you're going to see CD rates then all of a sudden look really good and really attractive. I don't think so. If you're borrowing, mortgage rates likely come down a little bit, and they have, but mortgage rates likely come down a little bit. We're seeing the housing market being a little bit stronger, right? As we're just on the cusp of the housing market season. So interest rates are going to respond to that, but this suggests that we shouldn't see a spike in interest rates back to all-time highs. A lot of other factors there, but that suggests that. But what about short-term debt, credit cards? No bueno. This is still not good. The average credit card interest rate is over 19% right now, guys. That is an average, or that is a record high. And because of this interest rate move, because it was still up, even though it was just a little, still going to put pressure on credit card interest rates. So short-term borrowing, you've got to watch it. You've got to be careful. How does this interest rate move impact you? I hope that helps. Does it influence your financial plan, your financial decisions? Work with your CFP on that. If you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.